You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome back. We're here to help you cut through all the noise in crypto. There's just so much happening.
Oh, definitely. It's moving fast.
So today, we're looking at some really significant stuff, court cases, new tech, trying to give you the key takeaways.
Exactly. We'll dig into some important legal rulings, some tech that's really changing how people access the market, and maybe bust a few myths about, what actually matters versus just hype.
Okay, let's kick things off with a legal one then. Yuga Labs' Bored Ape Yacht Club. That name rings a bell for most people, I think.
Yeah.
There's been a development in the U.S. courts.
That's right. The Ninth Circuit Court of Appeals weighed in, and they basically said that NFTs, like the Bored Apes, can be considered goods when it comes to trademark protection.
Goods, like actual physical products.
Well, under the Lanham Act, yes, that's the main federal trademark law, so it means they get treated similarly for brand protection. It's a pretty big win for IP rights in the NFT space. But the actual case against Ryder Ripps, the artist, that's not quite done. It still needs to go back to trial to figure out if people were actually confused by his project.
Got it. So a step forward for NFT IP, but the specific fight isn't over. Now, speaking of legal fights, things seem to be getting, well, really intense with this expanded RICO lawsuit.
Oh, yeah. This one's escalated. So RICO, that's the Racketeer Influenced and Corrupt Organizations Act, usually for organized crime stuff. This amended lawsuit now pulls in the Solana Foundation, Solana Labs, Jito Labs, and even top execs like Anatoly Yakovenko and Raj Gokul. The accusation is that they essentially helped run an illegal digital gambling and money transmission setup through Pump.fun.
Seriously, what are the specifics they're alleging?
Well, violations of anti-money laundering laws, the Bank Secrecy Act, really serious claims. They even allege Pump.fun was used by the Lazarus Group, the North Korean hackers, to launder funds stolen from Bybit. We're talking huge numbers, like $723 million generated, reportedly.
$723 million. Wow.
And Jito Labs specifically is accused of front-running trades using MEV, minor extractable value, basically manipulating transaction order for profit.
Okay, that's a heavy set of accusations.
Oh, yeah.
An unregulated casino and money laundering operation. Huge implications if proven. Let's maybe shift gears for a second. Away from the courtroom, towards tech that's actually reaching users now.
Good idea. So, Telegram. They've just launched their built-in TON wallet for users in the U.S., and it's self-custodial.
Self-custodial, meaning users hold their own keys, right?
Yep.
Not Telegram.
Exactly. You control your crypto. It lets you do transfers, swaps, buys, all right there inside the Telegram app. It's apparently already got over 100 million users globally.
100 million? That's a massive reach.
It really is. And with stablecoin support, MoonPay integration, it's designed to be super user-friendly. Honestly, it looks like a real challenger to platforms like Cash App or even Coinbase for bringing more people into crypto easily.
Interesting. Okay, staying on tech disruption, I heard about something called Hyperps from Hyperliquid. Sounds futuristic.
It kind of is. They're launching on-chain perpetual futures, but for private companies. Think like Stripe or OpenAI before they IPO.
Wait, so you can trade on the value of private companies on-chain?
That's the idea. A transparent 24/7 market. The goal is to completely bypass the traditional investment banks and their whole book-building process for IPOs.
The process that often underprices shares and keeps retail out.
Precisely. They argue it often leaves 20–40% on the table and excludes regular investors. Hyperliquid wants to democratize that early access, calling the old way legalized front-running.
That's a bold claim. Challenges, though. Regulation, liquidity.
Oh, for sure. Regulatory hurdles will be huge, and getting enough initial liquidity is always tough. But the potential to disrupt how IPOs work, it's pretty immense.
Okay, so we've got legal drama, new user-friendly tech, potentially disruptive finance. How do we make sense of the market itself amidst all this? I heard you mention a slightly unusual indicator, something about watches.
Yes, the Rolex indicator. It's kind of fascinating, actually. We looked at luxury watch prices, specifically Rolex, as a sort of proxy for speculative heat in crypto cycles.
How does that work?
Well, back in 2021, Rolex prices really shot up, but mostly after Bitcoin hit its second all-time high and the NFT craze was peaking. It lagged a bit.
Okay.
What's interesting now is that even with Bitcoin near its highs again, those Rolex premiums, They're much more subdued. They haven't gone crazy yet.
So what does that suggest?
It suggests we're probably more in the middle of this cycle, not right at the frothy top. That peak retail FOMO, signaled by watches maybe selling for double retail price, we're likely not there yet. So for you listening, maybe there's still time to strategize before things get really overheated.
That's actually a really neat, tangible way to think about it. Okay, last thing. Let's talk token launches. There's always so much hype, especially on crypto Twitter. What actually works?
All right. So someone analyzed a ton of data, like 50,000 data points across 40 major token launches planned for 2025.
And, yeah, did the usual Twitter playbook work? Buying followers, tiny floats, big VC announcements.
Get this. Almost zero correlation between that stuff and how the token actually performed after launch.
Really? So all that noise
Yeah.
is just noise.
Pretty much, according to this analysis. The one thing that showed a statistically significant link was the initial market cap, the IMC, how the project was valued right at launch.
Okay, so launch big.
No, the opposite. Larger initial market caps actually predicted weaker performance later on.
Huh. So starting too high is bad.
It seems so. The real drivers of success. Things like realistic launch valuations, having a product that actually does something useful, genuine communication over time, and showing strong, sustained trading volume. Forget the hype machine.
That makes sense. Utility and realistic expectations matter.
Exactly. And, despite the noise, the underlying market still shows strength. You've got stablecoins offering pretty attractive yields, like 15% to over 60% APR in some cases.
Wow.
Ecosystems are growing Axiom, bringing in revenue, fluted lending growing steadily. Plus, you have things like the Bitwise Spot ETF getting approved, showing more mainstream acceptance.
So quite a landscape. We've touched on NFTs getting defined as goods, the serious RICO allegations against major players, Telegram making crypto easier for millions, Hyperliquid challenging IPOs, and even using Rolexes to gauge market temp. Plus debunking some token launch myths.
It's a lot, yeah. And it all kind of points towards this ongoing collision, doesn't it, between traditional finance and these new, more democratized tools and insights coming from crypto and DeFi.
Which leads to a good question to leave everyone with.
Right. Thinking about all this, the easier access, the new financial instruments, the transparency push, even the regulatory scrutiny, how do you think this continued democratization will ultimately change traditional markets? And what sort of new opportunities or maybe new challenges will pop up as these two worlds keep smashing into each other? Something to chew on.
Spoken Tech for your ears.